Welcome to UBP TV. We had a very interesting month of November because on the 7th, the ECB cut its main refinancing rate to 0.25%. That was a bit unexpected. And they did it to show their commitment to providing liquidity or more liquidity to the Eurozone economy. And they will do even more in the future. They have to find a way to relaunch the credit cycle over there. At the same time, the Fed will start its tapering process. The economy is better than expected in the US and we continue to pick up. That was obvious in the last Fed minutes on the 20th of November and in the Beige Book on the 5th of December. Therefore, we expect the Fed to start its tapering process beginning of next year. We stick to our forecast for March, but it's possible that they will start a bit early in January. Therefore, you can see that the ECB will be more generous in terms of liquidity and the Fed will be less generous. That is a kind of decoupling. But nevertheless, both central banks and all central banks in developed markets will remain very accommodative. So we still believe that the equity bull market will continue on developed markets. And equities remain our favorite asset class. Despite that, in November, once again, we had very negative earnings revision, especially in Europe, where we expect now a contraction in profits for the whole year 2013. And in the US, we had also some negative revisions, so the earnings growth for the time being is a bit disappointing. Therefore, that's why next year, beginning of next year, we will need the kind of earnings growth which is expected, so double-digit earnings growth. And we are confident that companies in Europe and in the US will deliver and even will surprise on the upside. Therefore, we remain bullish on equities. At the same time, after 8 weeks of rally, the markets probably went a bit ahead of themselves, and therefore a correction is needed to consolidate the gains, the recent gains. In the fixed income space, we continue to recommend short durations. And regarding corporate bonds, it's true that spreads are tight currently, and it's difficult to imagine they will tighten further, even if the economy improves going forward. Nevertheless, given to its high carry, we still recommend to have high-yield bonds in your portfolio, but we don't recommend to add up to existing positions, just to keep these positions. We keep our asset allocation unchanged. We have a high equity risk currently in the portfolios. That's what we want. We want to start the beginning of the year 2014 at full speed because we think the beginning of the year will be very positive, even if we have a correction currently. And if you add up for high yield and convertible bonds, which have a high equity component embedded, our equity allocation is close to the maximum. Thank you very much and see you next month.